And I always tell people there's three people in this world. There's the informed, the uninformed, and the misinformed. Which one are you? So if you're currently buying real estate right now, either you're flipping houses or buying real estate right now, but you're not using life insurance to purchase real estate, I believe what you're about to hear is going to be really good for you. Also, if you have a cash value life insurance, you mentioned, Omar, you had one maybe in the past, but weren't very familiar how it works. If you currently have a cash value life insurance right now and you're looking to purchase real estate with it, this show is going to be really good for you also.
Just to learn a little bit more about you two, Frank, I want to start with you. Could you just tell us a little bit more about your background and how you kind of came to, becoming an expert in this field?
My name is Francisco Oregel. I go by Frank. I've been in the industry for about 14 years now, and my main objective is to help individuals and business owners how to grow and save money. And we do this by specializing in certain tax codes that really are not utilized or maybe not even known about by your average CPA. The cool thing about it is that I work with CPAs and tax professionals to further benefit the client.
My name is Carlos Anzures. I've been in business. I've been an entrepreneur in business and for 19 years in the financial services industry. Started doing real estate and mortgages and made my way into this sector. And yeah, like Frank mentioned earlier, our goal is to help individuals and business owners maximize their gains and minimize their taxation by leveraging the tax code.
If you are buying real estate at the moment, but not using life insurance as a way to do that, how would someone go about learning more on how that would work? Carlos or Frank?
Most people, when they purchase real estate, they're using their bank account. Essentially, they're using the bank account to wire money to escrow, or they're getting a cashier's check, whatever they're doing. They're using their bank. So life insurance is a vehicle, right? It's a vehicle that it can be used in substitution of a bank. And before I go into that, why I'm going with this is we have to understand how life insurance even allows you to do that to begin with. So first of all, there's our IRS code, IRC 7702. So Internal Revenue Code 7702 says that if you have an investment grade life insurance, all the proceeds that come out of that account are, even the gains, are 100% tax free. If you were to have your money in the bank and you make any kind of gains on it, they have to be reported as gains to the IRS. Inside a life insurance policy, they don't have to be reported because it's under Internal Revenue Code 7702. That's what number one. Number two, you got to understand that nothing happens without insurance. For example, banks wouldn't even exist if there was no insurance. For example, there's something called the FDIC. FDIC stands for Federal Deposit Insurance Corporation. Nobody's going to invest money in a bank and deposit money in there unless they knew their deposits were insured. So nothing real. You can't even purchase real estate without have homeowners insurance. You can't even get a financing if you're not putting more than 20% down because you have some kind of insurance on it called mortgage insurance. So nothing happens without insurance. And so 7702, an investment grade life insurance, you can utilize it by instead of putting your money into the bank, you can put your money into a life insurance contract where you're able to use it just like the bank and use it to purchase real estate.
So the tax code 7702 was passed in 1982. It's the Tax Equity and Fiscal Responsibility Act. And that was something that Carlos was explaining earlier. And basically it's a life insurance that has a cash value component of which if prepared properly, there's really no limitations on how much money you can grow into it, right? The awesome thing about what we do is we do individual plans that are tailor-made to the person looking for that investment growth, so that when they take money out, it's entirely tax-free, right? So the strategy behind everything is doing an individual plan that's curtailed to the individual person on what their goals and needs are economically.
There's two types of investment grade life insurances. There's two. There's a bunch of different types of life insurance. The one we're talking today in particular, it's two. It's either a whole life insurance, which is a cash value life insurance, or an index universal life, which is also another type of cash value life insurance. So those two types of life insurances can be used as an investment to purchase real estate.
Okay. Should we talk about the first one?
Yeah, let's talk about whole life. So, so there's three types the way money grows. There's only three types, okay? So there's one type called fix, right? And just in general in investing, doesn't matter where you go. Just like a mortgage, there's such thing as a fixed mortgage. If you put your money in a fixed mortgage, for example, and you get a 5% right now, the rates are going down. Let's just say you get a 5 or 6%, 30-year fix. It doesn't matter if the market goes up, the market goes down. It doesn't matter who wins. It doesn't matter what's going on with politics, what's going on with the world. You have a contract with the bank saying that they're going to give you a 30-year fix and that your rate's not going to change for the next 30 years. Doesn't matter what happens with the economy because you have a contract. Okay? So that's one way. The next way money grows, it grows in a variable market, stock market. You can make a lot of money, but you can lose a lot of money. That's called a variable. That's a variable. Your money can grow variable, like the stock market, which you can make a lot of money, but you can lose a lot of money. The third way your money can grow is called index strategy. An index strategy is a hybrid of the first two that I talked about. It gives you the peace of mind of a fixed account, but it gives you the upside of the market up to a certain percentage. So when I'm sitting down with my clients and I'm telling them, look, there's only three ways money grows. Which way do you prefer? So if they choose fixed, that will be a whole life insurance. That's fixed. So you're able to lock in a fixed contract. So no matter what's going on, your money's growing at that percentage no matter what. If you choose index strategy, then you're never going to lose money in that contract. And if the market goes up, you're going to participate in the gains of the market up to a certain percentage. So it's just a hybrid. So just depends on the client, what they're trying to do, what their time frames is, how much money they're investing, how many transactions they're doing. Everything has to be customized according to the client's needs.
There's death insurance and life insurance, right? So death insurance pays out when a person passes away, right? But alluding to what Carlos said earlier, life insurance, there's built-in strategies that have a cash component that you can take that money and reinvest it into, real estate or even other investments.
A scenario I want to present, which is something that I run into a lot, right? Because I work with a lot of first-time home buyers, right? Once we're going through the financial aspect of the loan, then we start talking more about just strategies of how, real estate works, what you could do to people want to get to the next level, right? And set their families up, right? And now with life insurance, how can I work that way in so we can make it a part of their strategy too?
First-time home buyers definitely need this for multiple reasons, not only to protect their American dream, but also if they choose to go into a cash value life insurance, it's even better because they can use that in the future to be able to purchase real estate down the road, especially their first-time home buyers. They say that the average, I believe the cycle, Omar, and you would know more than me because you're in the real estate game. I think the real estate cycle is 7 years right now. So every 7 years, someone's looking to sell or buy their home, another home. They're trying to upgrade. So the cycle is 7 years. So imagine that if your first-time home buyer understands cash value life insurance, 7 years later, they're able to leverage the tax code inside their life insurance policies to buy their other home versus them trying to sell their home to get another home or versus trying to strip some equity from their house because that's what they do. They strip the equity out of their house to use the money to be able to purchase another property. And then they figure, well, guess what? My loan amount's higher now because I stripped equity, but I'll let the renter pay that. And then I'll go into a new one again. But what if you can, outside of doing that, you have an additional way to leverage income or money or funds through a life insurance policy? I mean, we learn, if I want to buy another house, I got to sell my house or I got to save a bunch of money in order to buy another house, or I gotta pull a line of credit out. What if they can leverage a cash value life insurance to do that also? It doesn't have to be solely a life insurance policy. It can be a multitude of things. It can be cash money. It can be some equity. It can be, at the end of the day, I think everybody's ultimate goal here, regardless if you're a flipper, if you're an investor, I think everybody's ultimate goal at the end of the day, the end game here is to have passive income. That's what I believe. I believe, I always tell people, cash is king, and cash flow is kingdom, right?
Nice.
Cash flow is kingdom. Because I think at the end of the day, I don't care how many houses you're flipping or what you're doing, I think we're all after the same thing when we're in the real estate game. I think we're all looking for passive income and a secure asset that's collateralized through real estate. The safety of real estate is so awesome. It's a fixed asset, and it generates income for us. And that's the end game. I think why would you want to use life insurance to buy real estate? Because life insurance allows you to take care, leverage the tax code for tax benefits and legacy benefits. And then real estate's a very secure, safe, income generating asset.
Think about that, Omar. Carlos just went over like the entire investment side of the person that is wanting to leverage life insurance, and money growing inside a life insurance policy for real estate investment part, right? But then something that you said earlier, I work with a lot of first-time home buyers. Think about offering the protection, right? Because on that dual income that has to buy or that buys the home, just as men, what are we? We're protectors of our family, right? We protect the house, right? We bring food in. We protect our house. Mm-hmm. And think about this: if one day, because it's all going to happen, whether it happens prematurely or not, if you happen to pass away, you already know that house is going to be paid off. Your family's not going to be displaced. I think I saw a statistic one time that 88% of widows that remarry are because of financial needs, because they're in a financial burden, right? So think about the service you're going to be offering, not only for the investment side, like Carlos went over, but the individual person, that first-time home buyer, like Carlos mentioned, the American dream. I don't know if there's anything any bigger than that. You're not only, acquiring and attaining the American dream, but being able to protect it so that if one day, if it happens prematurely, my kids are going to be able to grow up in a house. They're not going to have to move. All the memories that they had there, they're going to stay there. And that's so deep for me. I'm real passionate about that.
No, I'm right there with you, Frank. As someone who moved around a lot when they were little, and they don't have the childhood home anymore, but I want that for my future kids and family members. That's the protection part we're talking about, right? You want to earn it, and then you need to figure out a way to protect it. Again, I think this is a new series that I'm going to have a lot of fun just kind of going through it with Carlos and Frank, because life insurance is such a big, wide topic. And I know there's a lot of dots that we can connect with real estate when it comes to just like, financial literacy, because I know those are topics that we are passionate about, and just getting more people aware of. Like, hey, life insurance, there's a way that you could use it to buy real estate. There's a way you could use it to avoid taxes. There's all this stuff that you just don't always find online. And it's kind of nice to hear it from a person than just to try to read it yourself.
Our financial literacy, and when we create portfolios for investors or the average person, are extensive. It's just not one thing. The topic today just happens to be using life insurance to buy real estate. The different strategies and concepts that are out there and how they're utilized, there are so vast, and we can take an average investment and make it into something that's going to compound and grow, so that when you withdraw it, it's tax-free. There's a lot of people investing in the stock market and in other money markets. And let me ask you this. When you withdraw that money, do you want to pay taxes on it, or do you prefer to have a tax-free withdrawal?
Yeah, I'm trying to pay the least amount of taxes as much as I can. When would it be the right time for anybody to kind of reach out to you? Like, what position in life do they have to be so it makes sense to talk to you?
I always tell people, look, when was the best time to plant a tree? And the real time was 30 years ago if you want to shade today. But the reality is no wrong time to get into these type of concepts and these strategies that we're talking about. We could be talking to a 21-year-old right now that's thinking, hey, I want to get in the real estate game, and I want to know how I can maximize my gains and minimize my taxation by leveraging the tax codes you guys are talking about through life insurance, because life insurance does offer that tax code. And so you can start even at a young age of 21, come to 30, you might be on your fifth, sixth home by then. You know what I mean? Oh, if you're 40 or 50, some people may be like, hey, I'm 50 years old. I should have done this 20, 30 years ago. It's never too late. The tax code's not going anywhere. And we just need to take advantage of it. It's out there, and whoever takes advantage of it is going to be able to leverage that code for tax avoidance purposes.
Absolutely. And if I could just add to what Carlos was saying, think about this: if you're starting an investment, what makes more sense? To start earlier in life, so you could take advantage of what Carlos mentioned earlier about an index strategy. When the market goes up, your money goes up, right? When the market goes down, you lock in your gains and don't lose anything. So would you want to take advantage of that at an earlier age, maybe like even after being 6 weeks old? Or would you want to take advantage of that, 30 years down the road? Of which the reality is we can help anybody in whatever financial position they're in. But I think I like Carlos' analogy when he said, if you wanted shade, you're not going to plant a tree like 10 years ago. You're going to plant it 30 years ago.
Mm-hmm.
But it's never too late. But it's never too late to start. And every scenario, Omar, is different. Everybody, for example, you do real estate. So when somebody wants to purchase real estate, it all depends. Most people are trying to get multi-units because they're looking for rental income. They're trying to leverage the other units to pay their current rent. They're trying to leverage that. Maybe that's what they want to do. Maybe they don't want neighbors. They want a primary home. They want peace and quiet. And they want to raise their children there, and they want good schools. So then their experience that you're gonna customize for them, Omar, it's gonna be based on their current needs. Same thing with us. It depends. Are you looking to buy commercial property? Are you looking to buy real estate? Are you gonna do flips? Are you gonna buy and hold? Or are you a beginning investor that's trying to leverage the tax code at a young age right now? So 5-10 years from now, you have an account that you're able to leverage to be able to purchase real estate. So every scenario is different on the client's needs and based where they're at financially. And we'll talk about the pros and cons in a bit. But one of the things that people think they can do, you just can't purchase a life insurance for right now. Like I purchased a life insurance right now. It's a cash value life insurance. It really has no value because in the cash account because I haven't invested long enough. And I'm trying to, there's no money for you to, it's like a bank. You open a bank account today and you open it with $200 at Chase and you're looking to purchase real estate with $200, it's not going to work. However, if you open up an account that maybe you had some money saved that you want to start with $20,000 into a savings account, you can leverage those $20,000 from day one in a savings account to put down on a down payment, perhaps on a condo or a townhouse or a distressed property. And your journey begins there. So a lot of the things people think they can just get a life insurance today, but if you don't invest in it, it's like a withdrawal, right? You can't withdraw something you haven't deposited into. And I think that's one of the biggest misnomers. And when people are buying real estate with life insurance, they think they can just buy a life insurance today and they can buy a real estate tomorrow, which they can if it's properly funded and properly structured.
That was the biggest takeaway I got when I was preparing for this episode, was understanding and for it to really click that the way the policy is structured can make all the difference between if you can get your money and start utilizing it that same year or 20 years from now, depending on what you want the outcome to be. Because I always thought of life insurance as a death benefit, not as something I pay into it while I'm still living and I could still use the money while I'm still living for potentially buying real estate and using that as a strategy to better my life. I had no idea.
Absolutely. Yeah. And life insurance has evolved kind of like the car, right? I mean, the first car that was ever invented, you turned it on with the crank, right? You had to be outside of your car, have a big crank, and crank it and turn it on. Now with the advancements of technology, if you have an iPhone or a smartphone, you can turn your car on from your phone, right? And the cool thing about that, Carlos and I, in this industry, is that we're on the forefront of everything new that's coming in, right? So life insurance isn't just life insurance no more. The wealthy and the investors that really understand it can leverage it as a tool to purchase real estate or other investments. And the awesome thing about it is that it's protected in a way that if that person does pass away, the death benefit part goes to the family entirely tax-free. So not only are we using it as an investment tool, but we're using it as a generational tool for tax-free income.
Absolutely. I love what you said right now, Frank. Really, Omar, the life insurance in today's world is like the Swiss knife of financial services. It's almost like a phone, right? A phone is everything now. Before it was just to make a phone call, right? Now it tells you the time zones, the apps are on there, your wallet's on there, your photo album's on there. I mean, everything's on there. I mean, you're more scared to lose your phone than you are your house keys or your car keys. You lose your phone, it's like the world's ending, right? And so same thing with life insurance. There's so many ways there's so many benefits to life insurance, especially cash value life insurance in particular, the one we're talking about today, that most people have no idea about. And I always tell people there's three people in this world. There's the informed, the uninformed, and the misinformed. Which one are you? And that's our goal today. Our goal is to bring that information, to bring that knowledge of how these types of policies by leveraging the tax code work.
If you wouldn't mind, let's dive a little deeper and kind of geek out a little bit.
The way these policies are funded, they're funded with their after-tax money. If I go in there and I pull out $20,000 out of my bank account with Chase and I fund a cash value life insurance, no matter what, if it's whole life or index universal life, I fund the policy. Let's say the policy starts accumulating gains through the years. And let's just say I don't want to pull my money. Let's say I want to pull my money out today. Okay. So basically how it's structured, I put the money in the policy and I want to pull it out right away. Well, based on the way it's designed, let's say I'm able to pull out 90%. You're never going to pull out 100% of your money. You can't, because that means you cancel the policy. Because people are like, can I put 20 grand and pull it tomorrow? You can't pull 20 grand because then you cancel the policy. It's like if you open an account with $200 and you cash them out, you basically close the account. So let's say 90% of my money, I'm able to pull out day one, and I'm able to use that money to fund in a real estate investment, to buy real estate, for whatever it may be. The account, when I pull the money out, when it's my money, right? It's something called withdrawals and loans. When it's your money, it shows as a withdrawal. It shows as a withdrawal. It shows as a withdrawal. And then later on the gains, it shows as a loan, because loans are not taxable. That's how they get away with it. Loans are not taxable. You can get a loan at Wells Fargo. You're not going to pay taxes on a loan. Nobody pays taxes on a loan. You pay interest, but you don't pay taxes on it. And so that's one of the ways that people don't understand. Like so there's withdrawals and loans, and based on how we design it, either way, you're not going to get taxed on it. Now, while you pull your money out, the account, even though $18,000 are out of there, or $17,000 or $15,000 are out of the account, and a bigger account, let's say you have $200,000 and you pull out $160,000 in one shot, and you have 40 in there, even though the 160,000 physically, they're in your hands. You got them already. You took out the $160,000 out of a $200,000 cash value life insurance. There's 40 in there sitting there. The account's gonna think and grow like you still have the 200,000 in there. Because essentially what you're doing, you're saying you're getting a loan from your own money, You're not cashing it out. You're just getting a loan from your own money, 160,000, right? You become, essentially what you do, Omar, you're becoming your own bank. You're becoming your own bank. And that's when it gets a little sticky. That's when it gets a little bit more advanced, because when is it a withdrawal? When is it a loan? How much do I pull out? It's all how it's structured and funded, to be honest with you.
I want to pause there, because that I really want to make the distinction with what you said between either a loan or taking a withdrawal from your account. There's a big difference on how the taxes work for those two things. Could you repeat that?
Yes. So withdrawal is your own. Remember, it's funded with your after-tax money. It's funded with your after-tax money. So that money, let's say I funded with $100,000. $100,000 is not taxable because it's my after-tax money. It's money that I have in my account already. It's my money. It's I can do whatever I want with it.
So what Carlos is doing, he's basically explaining a strategy that exists within certain tax codes, right? So for example, a loan cannot be taxed. That's just what the bottom line is. And that's what Carlos is alluding to. You're going to loan yourself money, which, emphasizes what the, what like the taking a loan like from a bank, right? With the bank, there's interest and so much and so forth, and you got to qualify and you got to pay it back and whatnot. When you take a loan against your own money, that's your own money. There is some interest that is charged there, but if your rate of return is higher than your interest, then it's a wash, right? It's a wash. Another thing that Carlos was mentioning too about, investing certain amount of money and taking certain amount of money out. One thing that I like about working with Carlos is that, we use the boxing analogy. Carlos and I are like the 1-2 punch of financial services. We bring not only the concepts and the ideas that are already working, but we also bring the education behind it, right? So when Carlos was saying, hey, you can't put 20,000 in and put 20,000 out, it's because it'll turn into something called a MEC, a modified endowment contract, which then if you take the money out or more than what you're supposed to, then it becomes a taxable event, right? Or if you overfund it, it becomes a taxable event. So the super awesome thing about what we do is that every situation is different. They might be similar to other cases, but they're different. Why? Because everybody's outcome or everybody's end result is different, right? So think about this. When you're working with us, not only are you going to get our individual undivided attention, but it's going to be curtailed to what you're looking to do, right? With what you have to invest right now, what your strategy is, right? Whether you started early at a young age and you had money compound interest for a long time in an already existing life insurance policy that has this component, or maybe you're a new investor that says, hey, you know what? I want to put some money in. I want to take a certain amount of money out. But while I don't take it all out, I'm leveraging basically the system to compound and grow for me in a situation where I'm not going to take any market loss.
Like Frank said earlier, it's basically a loan against your own money. It's basically what you're doing. You're getting a loan from your own money. Frank mentioned something very, very important. That's why the policy has to be properly structured, because there is guidelines to it. There is rules to it, right? The IRS code has rules to it, just like a 401k or a 1031 exchange or a 1035 exchange or 1032. All those are tax codes. So there's rules to those tax codes. So there is rules in this life insurance game also that the individual, the corporation, or the business needs to understand prior to investing in a life insurance to purchase real estate.
Carlos said a very key word right there. This is different from a 401k or a pension or anything like that, right? This is leveraging life insurance to use it while you're alive and taking advantage of all the compound interest and free growth that it has within the life insurance plan. Right. So when Carlos and I sit with people, there's different types of investments, and we want to make sure that we're executing on what they're looking for. But very, very key, different from a 401k, very different. I would say the only similarities it has is that it either has a monthly, biannual, quarterly, biannual, or annual investment. After that, it's very, very different. But the leveraging on because think about this, most people that have a 401k or some kind of retirement plan, when they withdraw money, they have to pay taxes on that money. And because of the tax code that Carlos mentioned earlier, 7702, that's why it's tax free, and that's why the TEFRA law was passed in 1982. So all we're doing is leveraging laws that already exist to further benefit the client and show them how to create generational wealth.
If you're watching this and this is a topic that you've been trying to study and learn more about, let us know in the comments what you want to know more of, because again, Carlos and Frank are just a world of knowledge. They've been doing this for long enough where we can make another episode focused on some of your questions and what you guys are trying to see more of, especially if we can debunk, because there's so many misconceptions when it comes to life insurance and how you could use it for real estate, that I want to make sure that when you watch my channel, this is good information you're getting, because these are two industry insiders that do this every day. For Carlos and Frank, if you want to get started with them or just learn a little bit more about their business, I will include that in the description so you can have a way to get in touch with them.